Let's talk about Chapter 6. Chapter 6 deals with redemptions and liquidations of stocks of corporations. I'm skipping the big picture stuff when I do these, just FYI, so I'm just going to scroll past those and then talk about what a redemption is. They talk about it in the book right away in the chapter, page 2 of the chapter. I'll kind of give you a little bit of background about what they are. Make sure you read that on your own. Basically, it's qualified as redemption if the shareholder reports gain or loss on surrender of a stock. And generally just be thinking is what we're doing here is a stock redemption is when a shareholder sells stock back to an issuing corporation. The transaction can have the effect of a dividend distribution rather than a sale or exchange. This is quite typical when the corporation is actually just a smaller, closely held corporation. And so, of course, then we have to worry about is tax avoidance, and that's what the IRS, of course, is concerned about. So that's kind of the background, but make sure you read that on pages 6.2, a little bit on 6.3. Shareholder reports a gain or loss on surrender of a stock gained at favorable capital gains rates of either 0, 15, or 20% based on your income level. The shareholder reduces the gain by basis in the stock redeemed, and capital gains may be offset by capital losses if available, if the losses are available. If the transaction has the appearance of a dividend, the redemption will not be qualified. For example, if a shareholder owns 100% and the corporation buys half of the stock for X dollars, the shareholder still owns 100% of the corporation. That's kind of really what they're talking about here is when it's closely held and the stock is sold back, which ownership percent is still the same. If not qualified as a redemption, the shareholder reports dividend income. Individuals, shareholders may be taxed at the 0, 15, and 20% rates on dividends, but redemption proceeds may not be used to offset basis in the stock and cannot be used to offset capital losses. So there's a difference there, dividend income versus capital gains or losses. Corporate shareholders may prefer dividend treatment because the dividends received deduction. Remember, the corporation can get up to 70 to 80% of the dividends received deduction and not have to pay tax on that percent of dividends received. So I'm skipping the big picture stuff just so you know. So let's talk about transactions treated as redemptions. So the following types of distributions may be treated as a redemption of stock rather than a dividend. Distributions that are not essentially equivalent to a dividend, which is there's a test for that, or disproportionate distributions. There's some mechanical rules. So distributions not essentially equivalent to a dividend, there's a test we have to follow, or disproportionate distributions. The following types of distributions may be treated as redemption of stock rather than as a dividend. Okay. So distributions in termination of a shareholder's interest on the mechanical rules, or partial liquidation of a corporation where the shareholder is not a corporation is either. So this is where the shareholder is not a company, not a corporation, but is either the distribution is not essentially equivalent to a dividend, or an active business has been terminated, may be subjective to 1 or 2. The following types of distributions may be treated as redemption of a stock rather than as a dividend. A distribution to pay a death tax. There's a limitation on amount of allowed distribution, and stock attribution rules must be applied. So the distribution may, which appears to meet requirements, may not qualify. So let's talk about stock attribution. Qualified stock redemption must result in substantial reduction in a shareholder's ownership. The stock ownership by certain related parties is attributed back to shareholder whose stock is redeemed. So just some examples of the rules here for stock attribution. It's Exhibit 6.1 in your book, and it says here that based on if you're a family, excuse me, if you're a partnership, estate, or trust, then is it, basically what are the rules for attribution? Is it deemed or constructive ownership? And you can see what those rules are right there. So family, for example, an individual is deemed to own stock owned by his or her spouse, children, grandchildren, or parents. Partnership, partners deemed to own the stock owned by the partnership to the extent the partner's proportionate interest is the partnership. Estate or trust, a beneficiary or heir is deemed to own the stock owned by an estate or trust to the extent the beneficiary or heir's proportionate interest in the estate or trust. In a corporation, the stock owned by a corporation is deemed to be owned proportionally by any shareholder owning 50% or more of the corporation's stock. So top of page 6 is where you'll find this information, top of page 6. Family attribution rules can be waived for redemptions and complete termination of a shareholder interest, and stock attribution rules do not apply to partial liquidations or redemptions to pay death taxes. Okay, I'm skipping the big picture stuff. Not essentially equivalent redemptions. Redemption qualifies for sale or exchange treatment if not essentially equivalent to a dividend, subjective to a test. A provision was added to deal specifically with redemptions of preferred stock, where shareholders have often no control over when preferred shares are redeemed. Also applies to common stock redemptions. To qualify, redemption must result in a meaningful reduction in shareholders' interest in redeeming the corporation. Indicators of a meaningful reduction include a decrease in the redeeming shareholders' voting control, and reduction in rights of redeeming shareholders to share in corporate earnings, or receiving corporate assets upon liquidation of the corporation. If redemption fails to satisfy any of the qualifying stock redemption rules, then is treated as an ordinary dividend and taxed accordingly. Basis in stock redeemed attaches to remaining stock owned, okay, directly or constructively owned. Redemption qualifies as disproportionate redemption if the shareholder owns 80% of the interest owned prior to the redemption. The shareholder owns less than 50% of the total combined voting power in the corporation after redemption. So here we have the shareholder 60% ownership. 60% ownership represented by 60 of 100 outstanding voting shares. So just an example of how you would determine what the percent of ownership is. And then the redemption is the shareholder transfers 25 voting shares to the corporation, and the corporation pays cash and property to shareholder for the 25 voting shares. Shareholder has a 46 2/3 ownership, represented by 35 voting shares, and 60 of 25 of 75, 60 minus 25 and 75, which is 100 minus 25 outstanding shares. So just go back and take a look at these. You can see here that 60 shares is 60%, and then we did 25 transfer. So 35 voting shares, and now there's only 75 total shares that can vote. Redemption is qualified disproportionate because the shareholder owns less than 80% of the 60% owned prior to the redemption, and the shareholder owns less than 50% of the total combined voting power of the corporation. So basically how the ownership changed before and after the redemption. So before 60%, after then it became the 46 2/3%. Complete termination redemptions. So it says here termination of entire interest generally qualifies for sale or exchange treatment. Often will not qualify as disproportionate redemption due to stock attribution rules. Family attribution rules will not apply if the former shareholder has no interest other than as a creditor for at least 10 years and agrees to notify IRS of any disallowed interest within that 10-year period. Non-corporate shareholder gets sale or exchange treatment for partial liquidation, including distributions not essentially equivalent to a dividend, and under a safe harbor rule, distribution pursuant to termination of an active business. To qualify, distribution must be made within taxable year plan as adopted or the succeeding taxable year. Not essentially equivalent test looks at effect on the corporation, requires genuine contraction of the business of the corporation. Under the safe harbor rule, to meet complete termination of a business test, the corporation must have 2 or more active trades or businesses that have been in existence for at least 5 years, and terminate one trade or business and continue a remaining trade or business. Okay, now redemptions to pay death taxes. There were some exceptions for death taxes that were mentioned earlier. Allows sale or exchange treatment if value of stock exceeds 35% of adjusted gross estate. Stock of 2 or more corps may be treated as stock of single corp for 35% test if 20% or more of each corp was owned by the decedent. Special treatment limit to sum of death taxes, funeral and administrative expenses of settling the estate. Basis of stock is stepped up to fair market value on date of death when redemption price equals stepped up basis and no tax consequences to the estate. The gain or loss recognition: if property other than cash is used for redemption, the corporation recognizes gain on distribution of appreciated property, and a loss is not recognized. The effect on earnings and profits: E&P earnings and profits is reduced in a qualified stock redemption by an amount not in excess of the ratable share of E&P attributable to stock redeemed. Corporate expenditures incurred in a stock redemption are not deductible. Accounting, brokerage, legal, and loan fees. So a redemption where there is no sale or exchange treatment, redemptions not qualifying under previous provisions are treated as dividend distribution to extent of E&P, earnings and profits. Attempts by a taxpayer to circumvent redemption provisions led to rules covering preferred stock bailouts and sales of stock to related corporations. Okay, so let's talk about preferred stock bailouts. A little bit about this is on page 13, a little bit of background and some consequences there for taxes are on page 13 to take a look at. They involve corporate distribution of non-taxable, non-voting preferred stock, dividend on common stock. The portion of basis in common stock is allocated to preferred stock. A shareholder then sells the preferred stock to a third party. The effect is a bailout of corporate profits as a capital gain without reducing the shareholder's percent in ownership of the corporation. To minimize abuse of this, and of course then minimizing taxes, the code requires treatment. Shareholder has ordinary income on sale of preferred stock to third party, and the amount of ordinary income is fair market value of preferred stock on date received as distribution from the corporation, treated as a dividend for the 0, 15, 20% tax on dividend income, but has no effect on the corporation's E&P, earnings and profits. To minimize abuse, the code requires no loss recognized on sale of tainted preferred stock, and the stock is redeemed by the corporation. Proceeds are treated as a dividend to the extent of the corporation's E&P. Section 306 stock is stock which is not common stock, received as a non-taxable stock dividend, received tax-free in a corporate reorganization, or has a basis determined by reference to other Section 306 stock. If a corp has no E&P on the date of distribution of a non-taxable deferred stock dividend, the stock is not a Section 306 stock. Okay, let's talk about redemption with related entities. When one corporation acquires stock in another corporation from a shareholder, and the shareholder controls both corporations, direct or indirect ownership of at least 50%, Section 304 requires that the redemption results in a reduction of ownership interest that would satisfy one of the qualifying stock redemptions. If the redemption does not qualify under those rules, the transaction is characterized as a dividend distribution and taxed accordingly. When brother and sister corps are involved, the stock received by acquiring the corp treated as a capital contribution. The corp's basis in acquired stock is same as shareholders' basis. Shareholders' basis in acquiring corp is increased by basis of stock surrendered. If one corp controls another corp, the stock and subsidiary can be distributed to shareholders tax-free if requirements in Section 355 are met. Okay, liquidations. There's some information in the chapter, pages bottom of 14 and 15, about some liquidations. Corporation winds up affairs, pays debts, and distributes remaining assets to shareholders. So basically decide to liquidate. Produces sale or exchange treatment to a shareholder. Liquidating corporation recognizes gains and losses upon distribution of its assets with certain exceptions. Gain or loss is recognized by a corporation on distribution and complete liquidation. Loss may be disallowed or limited if property distributed to related parties, property distributed has built-in losses, or a sub's liquidating distribution to its parent corp or its minority shareholders. Property treated as if sold for fair market value. The result is a liquidating distribution subject to corporate level tax gain and shareholder level tax receipt of the proceeds. So potentially there's some rules there we have to be concerned about with liquidations. Limitations on losses for related party situations. Losses are disallowed on liquidating distributions to related parties if the distribution is not pro rata. In pro rata distributions, each shareholder receives their share of each asset. The property distributed is disqualified property. Disqualified property is property acquired by a corp in a Section 351 transaction during the 5-year period ended on date of distribution. For limitations on losses, the built-in loss situations, losses are disallowed when property distributed was acquired in a Section 351 transaction, and the principal purpose was to cause recognition of loss by a corporation on liquidation. And the purpose is presumed if transfer occurs within 2 years of adopting a liquidating plan. Okay, so some of the rules we have to be concerned about and thinking about. And these flow charts are always good to refer to, so I'm going to kind of make a point that we might have to refer back to slide 53 to remember some of these. And I'm trying to find exactly where it's at in the book, and for some reason I had my notes and I just don't see it. But let's just make a note that when we talk about distribution of lost property in liquidation, we'll then make a note of slide 53. That'll help us make some decisions. And it says here that starting at the top, liquidating corp distributes lost property. Was the distribution non-pro rata to a related party? Yes. Loss is disallowed? No. Then we look at, was the property distributed disqualifying property acquired by the liquidating corporation in a 351 transfer, or as a contribution to capital during the 5-year period ending the date of the distribution? If the answer is no, loss is allowed. If the answer is yes, then the question is, was the distribution to a related party? If the answer is yes, it's disallowed. If the answer is no, then we have to ask one more question. Was the principal purpose in transferring the property to a liquidating corporation the recognition of loss by the liquidating corporation? Such purpose is presumed if the transfer occurred within 2 years of the adoption of the plan. The answer is no, loss is allowed. If the answer is yes, built-in loss that occurred prior to the transfer of the property of the corp is disallowed. So kind of the decision tree to think about as we go through that. So liquidations, the effect on the shareholder, that was before we talked about liquidations, the effect on the corporation. So now it's the effect of the shareholder. Page 21 is a good start to take a look at that. Gain or loss recognition and receipt of property from liquidated corporations. The amount equals the fair market value of property received, the basis in the stock, generally capital gain or loss. Okay, so fair amount is fair market value of property received minus the basis, generally capital gain or loss. Basis and asset received in liquidated distribution is the fair market value on the date of distribution. So the basis is the fair market value on date of distribution. There's a special rule for installment obligations. Shareholders may defer gain recognition to a point of collection. On installment obligations, corporation must recognize all gain on distribution. Okay, liquidations for parent subsidiary situations. Page 22 has some information about this. The parent corp does not recognize gain or loss on liquidation of subsidiary. Also, the subsidiary recognizes no gain or loss on property distributions to a parent. To qualify, parent must own 80% of the voting stock of the sub. The sub must distribute all property and complete cancellation of all of its stock within the taxable year or within 3 years from close of tax year in which the first distribution occurred, and the sub must be solvent. Liquidating distributions to minority shareholders. The sub corp treated the same way as a non-liquidating corporation. Distributing corp recognizes gain but not loss, and minority shareholders recognize gain or loss. The amount is the fair market value of property received minus the basis in the stock. Basis of property received by parent has same basis as sub's basis unless election is made under Section 338. Parent's basis in sub stock disappears. The parent acquires tax attributes of sub. Example, not net operating losses, business credit carryovers, capital loss carryovers, and the sub's E&P may result in some inequities. Okay, Section 338 election. On page 24, parent may elect to treat acquisition of stock in acquired corp as purchase of the acquired corp's assets if election is made by 15th day of 9th month following the qualified stock purchase, and a qualified stock purchase occurs when the corp acquires stock representing 80% of the voting power within a 12-month period. Must be acquired in a taxable transaction. Stock purchases by affiliated group members count. The tax consequences: the parent corp has basis in sub's assets equals basis in sub stock. Sub may but not need be liquidated. And the sub is deemed to have sold its assets for an amount determined with a reference to parent's basis in sub stock adjusted for liabilities of subsidiary. Gain or loss is recognized by sub. The sub is treated as a new corp that purchased all of its assets on the day after the qualified stock purchase date. Okay, so with that we'll end it, and then I'll do another recording that talks about just some of the problems and gives you plenty of examples to follow with the problems, and we'll go from there.